Welcome to Stocks Review. Click the subscribe button for more up-to-date stocks and portfolio review. Today we are going to take a look at Alibaba. Stock ticker symbol BABA. It is headquartered in China and service region majorly in China. You may ask why we should care about where the company is headquartered? This is because companies in developed countries tend to be better regulated, whereas companies in developing countries tend to have higher growth, but also more risk. Companies that are headquartered in authoritarian states also have higher political and regulation risk. The service region may give us a clue of the company's overall stability and long-term growth potential. It has a market cap of $237 billion and is considered a mega cap company. The market cap is an important metric because companies with larger market cap often have more pricing power, liquidity, and lower failure rate, whereas companies with smaller market cap tend to have more growth potential. What sector and industry the company is in greatly influences its ability to deal with market uncertainty. It is in the consumer discretionary sector and internet and direct marketing retail industry. Alibaba provides technology infrastructure and marketing reach to merchants, brands, retailers, and other businesses to engage with their users and customers in the People's Republic of China and internationally. It operates through 4 segments: core commerce, cloud computing, digital media and entertainment, and innovation initiatives, and others. The company operates multiple e-commerce and monetization platforms. In addition, the company offers pay-for-performance, in-feed, and display marketing services, and a real-time online bidding marketing exchange. Further, it provides elastic computing, database, storage, virtualization network, large-scale computing, security, management and application, big data analytics, machine learning platform, and Internet of Things services. Additionally, the company operates an online video platform and other content platforms that provide online videos, films, live events, news feeds, literature, and music. In short, it is a company considered as China's Amazon. The stock price has performed really bad. It has a 5-year price return of -25% and significantly lags the SPY. The 5-year price chart may help us evaluate how a company performed recently and its ability to weather global events, such as trade war, pandemic, and supply chain issues. It has a 5-year compound annual revenue growth rate of 48%. The revenue growth is cyclical, and the revenue trend looks very strong. The revenue trend is important as growing companies often have sales go up first, followed by profit growth. On the other hand, when sales become stagnant, it may also give us a hint that the growth phase of the company may come to an end if no critical change is made. The net income is growing. The net income trend looks ordinary, the profit is stable, however there is no consistent growth. The net income is one of the most important metrics an investor should be aware of. In the long term, stocks always follow the earnings trend. It has just started buying back its shares recently. We should always follow closely if a company is buying back or issuing more shares, as both of these activities greatly impact the return shareholders can get. It does not pay a dividend yet. The dividend history gives us a peek of a company's cash flow stability. The overall shareholder return of Alibaba is very bad and significantly lags the performance of the SPY. The total return and annual growth rate history of a company can show us what the performance trend was and how it had navigated through difficult times. Most companies tend to perform similarly, with a slight decline in growth as time goes by. Alibaba has a 8-year total return of -8% with a 8-year compound annual growth rate of -1%. If you had $1,000 invested 8 years ago, you would have $920 now. Currently, the price is at around 86 with a 52-week high at 240 and 52-week low at 73. It is near the lower end of its 52-week range. It has a P/E ratio of 23 and forward P/E ratio of 9. It has a cash position of 46 billion and long-term liabilities of around 38 billion. The ratio of cash, debt and market cap may help us evaluate the default or bankruptcy risk and what percent of your share is eroded by debt. Higher debt also has a higher cost in an elevated interest environment. Alibaba is considered a wide moat company according to Morningstar's rating. Now, about the future projection. Currently the margin is 7.9% and future margin after 5 years is expected to be 16.7%. The margin is expected to be increasing a lot after 5 years. The company's margin in moat reflects the pricing power of the company, and the projected trend is also important. We want to own a company that is able to stay profitable and relevant. It has a 5-year forecast revenue compound annual growth rate of 13% and 5-year forecast EPS compound annual growth rate of 13.1%. The near-term growth is expected to be good. It has equal beats and misses of analyst consensus EPS estimates in the last 4 quarters. That's not an impressive result. The overall analyst recommendation rating is a buy with trend shifting towards buy recently. The rating trend gives us a clue of the changes of what analysts thought about the stock. Out of 47 analyst 1-year price targets, the range is 99 to 312 with an average price of 175, which is well above the current stock price. The discounted free cash flow model is a widely accepted method for valuing a company. Here we present 3 kinds of discounted free cash flow model results for a more comprehensive review. If we run the DCF perpetuity growth model, the fair price is 136 with an upside of 52.5%. If we run the DCF terminal EBITDA model, the fair price is 155 with an upside of 74%. If we run the DCF terminal revenue model, the fair price is 165 with an upside of 84.6%. Now we compare Alibaba with US Treasuries and SPY. It cannot be emphasized more that the US 10-year Treasury yield is one of the most important numbers to keep in mind when investing in stocks. The 10-year Treasury yield affects the valuation multiple of stocks like gravity. The higher it is, the lower the stocks are valued, including all the S&P 500 companies and all the stocks in the world. Currently, the 10-year Treasury yield is around 2.9%. The SPY is considered one of the safest and most liquid ETF for investing in the stock market. Big funds and investors directly compare the risk and return of investing in SPY or in individual stocks. The historical return of all stocks follow the earnings trend long term. However, the real return is often reflected by a mix of dividend and buybacks together with revenue or profit growth affecting the valuation. The return yield of SPY is at around 10%. The SPY has an average forward PE around 18.8 now. Alibaba has a dividend plus 10-year growth forecast plus shares buyback yield at 10.4% and a forward PE around 9. We have to be cautious that this is just a rough prediction of Alibaba's future performance. The forecast can be changed at any time, and the actual revenue or net income the company is able to get depends heavily on the true market condition. Looks like Alibaba is cheaper than the SPY. Looks like it might be a good buy. We will try to summarize all the information above to give us an overall impression of Alibaba. In summary, Alibaba is a mega cap good company with good growth and wide moat, and probably undervalued now. If Alibaba can deal with the regulation and maintain its dominant position in China, then it may be a cheap stock to consider. Now that's a review for Alibaba stock. Click the subscribe button for more up-to-date stocks review. If you like our content, leave us a comment and click the like button to give us some support. We hope to see you next time.